Hi everyone, good evening. Today is Sunday, August 4th, and today that I'm going to show you. Usually, I was doing the calendar spread on every day. The many of the people were asking how we have to do that calendar spread and what are the like adjustments we have to do and also like in what conditions we have to take that particular trade. Each and every comments that I'm going to answer today, and I will explain about intraday calendar spread. Basically, I have divided this video into four parts. The first, I'm going to explain about what is calendar spread, and the next thing is I'm going to explain about in what market condition we have to take this particular trade, and what will be the risk reward, and how to maximize our profit to reduce the risk, and what is the adjustments. If you watch this full video, you are going to make lots of money in this particular strategy if you have a good enough of capital. And let's start the video that I'll explain each and everything one by one. Let's go to the condition is we'll understand first what is mean by calendar spread. Calendar spread is simple. If I say the calendar spread means particularly that I'm only talking about intraday. Let's take, we were having every day one expiry we were having. Suppose the Monday is mid cap, and Tuesday is fin nifty, Wednesday is bank nifty, Thursday is nifty, and Friday is sensex. The same way every day we are making it, we are executing this particular trade. Let's consider for Monday. Okay, Monday we have an expiry of mid cap nifty. Let's say, let's understand what is mean by calendar spread. Calendar spread is simple. In one word, selling at the money call and put option, selling at the money call and put option in the current expiry, and buying the next week call and put of current market price. Suppose if you can see here, 12,625 is the current market price. This was the current like current strike price, like it is a at the money strike price. And the next week I'll go and I'll buy the same thing. If you can see, this is the strategy. Let's put, we don't have any let's take 150 this one because we don't have the liquidity there. This was the pay up chart. Let's consider, now you understand what is mean by calendar spread. Let us see, I will explain one more time. Calendar spread is nothing but selling the at the money call option, put option at the current expiry, and buying the next week expiry at the same strike price. This is called as calendar spread. Now let's understand what is the fund needed for to sell a one quantity call and put. Is the required capital is 41,000. If you can see, the max loss is 26 percentage of deployed capital, and max profit is 17 percentage of deployed capital. And if you consider this one, probability of winning 80 percentage. Suppose if you have taken 100 trades, out of 80 times you are going to win this particular strategy if the condition is suits you. And the next thing is, now we understand what is mean by calendar spread, and we understand what, how much money it required to sell a call and put using the calendar spread. Let's go to our break even. I'll explain little bit about here. Suppose you sell at the money call and put, as well as you bought next week expiry. This was the break even. If you can see, 12,482 is 1.1 percentage of at the money to on the downside, means it is almost 1.1 percentage you are having. You are safe at a downside as well as 1 percentage on the upper side. This trade, and one more point, you need to execute this trade at 925. You need to execute this trade at 925. Let's say 1.1 percentage is the upside break even, lower side break even, and the upside is 1 percentage, and the fund is needed is 41,000. Even if you have a 1 lakh capital, your you can easily make adjustment as well as using 1 lot profit. Like usually you can make one 2000 to 3000 rupees every day. If you get a loss, you can able to reduce it. I will going to explain it how to reduce the loss if the trade went against us. Now we have understand what is mean by calendar, and we understand what is the capital is required, and we understand what will be the break even. Break even will depends on the like the premium that we are collecting. Suppose here we have a I premium, that's why it's showing the 1.1 percentage. Usually on the current expiry, on the same expiry day, it will be around like consider 45 this side and 45 this side. It will be like this only and the morning size, because that time it was a zero point 0.4 percentage is a break even. In this case, in this situation, the market may move up and down a power point percentage is a very common. If you can see, the probability is reduced now. It will automatically move like zero point 0.4 percentage and like 0.4 percentage up and down. There is I'll tell you how to do the adjustments and how to reduce that particular risk. Let's understand one more point. Like now we have understand what is mean by calendar spread and what is the break even point and what is the fund needed. Let's go to in what condition we have to do it. In the second part of this video, if you can see, there are two things that we need to consider. Let's go to kite, as well as we'll go to India VIX. You always you have to take the trade based on the India VIX, this particular trade, because whatever the buying positions we have, right, it should be always, it is good to take a trade in the lower risk. When we have a less than 14 or a 15 VIX, then we have to take this particular trade, because in that situation what will happen is, even if the market is moving in one direction, suppose if market is falling, the VIX will get shoot up and the buy value will also increase, and we won't get one side loss so much, and one side, even if it is that delta value get reduced, based on the delta value it will move, and it won't impact that much here on the based on VIX. If it is a less than 15, that's fine. If it is a less than 15 or a 10 like 11, it is very good actually. If you are buying above 15 or above 16, then it may chances are there, the buy position which you took, it will be go in loss, and it will impact your M to M loss, it will impact your M to M, as well as it will impact your psychology level. Now we, let's say there are three conditions. We can trade this trade every day which is having an expiry day. Suppose today is like suppose for example Monday is expiry day, mid cap Nifty we can trade, and if it is on the Thursday we can trade in Nifty. The same way we have to trade on the current expiry, and that should be the same day expiry. Suppose Monday is expiry and we can take the Monday we have to take mid cap only. That is how. If you take other trade, no, there are chances of very rare, like the premium will decay will be very less. So we have to take this. The risk is there, but the risk, to reduce that risk, I'm going to tell you that what we can do. Let's consider, now we have understand like every day we can trade, and we can trade. If you want to make more money, you have to take 1 week prior of budget, or any kind of event, big events like union budget, or let's consider election day. In before that, the IV will start spike up, so it gives the positive side, means the buy value will get also increase, and the sell value will increase because it will reduce, because the current expiry. And one more thing is, if you if and also if the IV is spiking up, your break even will get extend, because the premium that you are collecting will get increased automatically, break even get also increased. Suppose 45 you sell it, suppose the break even got like suppose 80 point it went, it automatically it reduce it, extending your the break even point, and nearby expiry it will anyhow it will going to zero on the one side, And if it is moved in either side, suppose if you went out of your break even, then we can do the adjustment. How we have to do the adjustment, I'll explain that in later point of video. And now we understand every day we can trade, we every day we can do the trading. And also if you want more profit from this strategy, we have to do on like prior of union budget or prior of election results or any big budgets. If the iv is more than like 2025, it is a very good. If iv is less than 14, it is very good strategy to trade. Now we'll understand one more thing. Now we have understand, and one disadvantage is we should not do trading when the budget is there. Suppose 22nd, for example, August 20 is the union budget. Let us consider I'm just telling an example. Monday is an, because if iv is already spiked up at the budget day, and it will get like it will get iv will iv will reduce that particular day in the budget day, after election, after result, after budget, so that the buy value will also decreases. So that's why we should not do trading on that this particular strategy on that days. Now we have understand what is mean by calendar spread and when we have to do the calendar spread. Let's consider what is a risk reward and how we have to do the, how we have to adjust. Like suppose if we can see here, like 80 percentage, like 27 percentage are taking a risk to make 18 percentage of profit, and the probability of winning is, let's consider that particular day is an expiry day, means we will the probability will be reduced like, okay, let's we have this point, 0.3 percentage, or like 45.545 is the premium. It will be like this, okay, point 4 point 4. Suppose if you take a trade at, let's consider if you take a trade at 925, at 11 o'clock the market is shoot up and it went your range. Let's zoom in. Suppose if the market is moved, you are out of the direction. Now you have, if you want to execute this particular trade, you need 1.5 lakh. If you have 1.5 lakh, you can make some good adjustment. Let's say this market is moved 0.5 percentage at 11 o'clock only. Let's see this, 12,675. Let's go to 12,675 strike price. 12,675. Sell, sell. And the next week, and buy, buy. Now, now this premium will be that time is around 35 and as well as around 30, or it will be in the money. That time in the money means it's a put options like suppose 50, and this will be around 50. Okay, we will be, it went already the out of the money. Suppose we, it is already like point 0.5 means 0.10 percentage, it is already crossed or break even and it went away. Now the situation is it is already in the 0.2 percentage away from the 0.2 percentage of the break even. Now still you are in the profit. Suppose if another 1 percentage, if it moves the another 1 percentage, now you are in loss of 4,000 rupees. Now what you can do is, you either you can exit this particular position, either you can exit this particular positions. There is a two ways, either you can exit this particular positions which is in the loss, or you keep that particular positions. Now go to 12,750 and sell the 12,750 strike price. That time this price will be, and we have to buy again the same strike price 750. And now that time it will be, the sell positions will be 750 call and this support. Okay, let me go, uh 675, 675, let's say like, okay, now we have to sell again the at the money call and put. This is the third adjustment. Either you can do that way, or you can remove the like current expiry and that particular trade which you executed first time, and you can take that positions. Like let's say you have sold initially, you have sold this one, and you will bought like 625. Okay, you will bought this one. Now what happened is, like zoom out, and this is around 150, let's say. Okay, now the market is moved. Sorry, there is some. Okay, 625, sell, sell, and August 625. Let's say this is how it is, and let's say premium is 150. And yeah, this is where the trade is, and it market is moved 1% away from your break even. Let's again go there and do the same. Whatever the strike price is there, 1270, 750. Let's take sell, sell, and buy 750. Now you see here the logic is, now that time particular trade is 750, means now it will be 1087, like around 50 to 60 point. Let's consider 60 point, this one, and 60 point. Now this is will be like this, and even if it moves the further, it will not move in one way direction. Even if it is in worst case, if it moves like that time, you are having the 3000 rupees loss. Like what we can do is, the one way adjustment is, we can remove these particular positions. We can remove these particular positions. Now we were having, this was removed earlier, which we enter, we have exited. That time this particular call option is went to around, if it is 1% means 150, this particular 100 it would have gone to, like, you are lost in the 50 point. 50 into 50, like 2500. We were having 4000, like to 600. And that time you can remove and you can add the new positions at the current market price. Again, if you can see, what is this, 845, 850, 850. Let's say 850, 850, sell, sell, again buy 850. Now you can see this one, 850, and 625 we will sell it, like 625, 625, 625, and 625. Yeah, this will be like this. That time we were having 26%, 26,000 loss, and 26 percentage and 7 percentage. Now that now the thing is, on the upper side, I don't think the market will move in the one way direction. If it moves the 1.5 percentage, at least it will fill like 0.4, 0.3 percentage. In worst cases, it will happen like this. In out of 5 days of expiry in the mid cap nifty, like 1 or 2 days it may move, like out of 5 days, another 3 days we will get a profit. Like in this particular day, even if it moves, like suppose if it closes in the 1.5 range only, like 2.5 it closes, means still if it come back, and if it closes in the negative, means that also, that time also we were lost in the 1.7 percentage only. We won't lose more than that value, like that what we are paying. If you are want to, like if you want to keep it everything, then it's good actually. We'll be having very good range to trade, and also it is very protective, like it gives the positive edge to it. But the margin will take more money, but for less margin people, it is not able to handle it. That is the one thing. And this is the, this is a, this is what the adjustments we have to do whenever, if until it's your, like suppose the break even is, until your break even is breaks, then only we have to do the adjustments, otherwise we should not. And also you have to consider the like technical analysis. Suppose if I go to your nifty, you have to check out these things, like these are the basic things. Suppose if nifty is crossing, like if you can see here, based on this one, it's nifty is already gap down by 200 points. it will not move in the one way direction. You can see based on this, you can able to say that one, like as a technical person, if you have 1 or 2 years of experience, you would have said this go for retesting, and if it is breaks this one, this goes for a particular trade, it may go, it will come back like this. You would have some basic knowledge about the retesting. Means if you can consider first time it went, you need one more confirmation, no? Suppose we will not going to take a trade on one single confirmation, it fell and it moved again, now again it went. In this, until this I breaks, we are not going to do anything. So if this I breaks, then we have to do, if our break even is this point, if I breaks aggressively like these candles in the positive side, we can do the adjustments. If not, we cannot. And let's say if in this lower side also, if we have this break even, it is break here, we have to take at the money call and put, again we have to sell this particular price. That is how we have to do adjustments based on, you have to take, you have to see the technical perspective. The main thing is you have to analyze the OI and you have to take the trade. And if small things like can give you the hedge, if you can see this one also, like if it is breaks this low and it may go down, like after this point only it went almost like 60 point 0.24 percentage. So this is also gives, when we do the adjustments, it gives the positive side angle. Now we have understand like what is the mean by calendar spread, and what will be the risk reward, and when we have to execute the trade, and how to do the adjustments. Now the thing is, you always think like, suppose if you can see, I'll clear the trade. One more magic about this trade is, I sell August future, August month. Let's take this one only, 625, 625, and buy. Now we have a, let's consider this one 150. Now we have a probability of winning is 75 percentage. Let's say one more thing, if market moves 1 percentage, let's consider market went against you and it moves 1 percentage, and you are going to do sell at the money call and put again, this is 750, 750, and you'll buy the 750 again, call and buy and call and put. If you can see the probability, and previously we were having the risk of 26 percentage, let's say 750, 750, I'll remove this particular positions. Now initially we were having 16 percentage the probability, like max win, max profit, and 27 percentage max loss, and the risk reward that we have is 75 percentage. Now I'll select everything. You can see the risk reward is, risk is same at 26 percentage, the reward is decreased. And because the break even got extended and we are paying some extra premium, we were already in the loss of this particular angle, like in the 75,000, right? Like on the call side we will be in the loss. So that is why it is taking a risk. But yeah, until like if you can within the 1 lakh rupees, if you are making a 4 5,000, it is very good amount. That is a great. And this is all about in this video, I hope you understand. Like in this video, if you can consider, just to recap, we discussed about what is mean by calendar spread, and how we have to do it in intraday, and what are the adjustments, what is the risk reward, what is the capital required for this trade. These are the things we have analyzed. And if you are want to learn more, if you have any kind of questions in this particular trade, you can always comment and ask the questions. I will clarify each and everything in the next video. Thank you so much for watching this video. And if you are new to this channel, please do subscribe and hit the like button. You are going to learn lot many contexts like this, content like this. Thank you all. Thank you so much. Have a good day. Have a good trading day and going forward. Thank you so much.